Over the last few weeks, macro has gone haywire with currencies, rates, energy prices, all trading like literal shitcoins. Meanwhile, the price of risk assets such as equities and cryptocurrencies has been going down the toilet. All of this pain and uncertainty has started to reveal some significant cracks in the global economy. Last week, the Bank of England had to step in and save the UK pension system from literally getting margin called. Now, a new doom loop scenario has entered the picture as Credit Suisse is looking like it's on the brink of collapse. Debit Suisse, as they're calling it on Twitter, has been all the rage on FinTwit, and people are wondering, will it collapse and drag down the entire global monetary system? Well, we've got all this and more for you today as we dive into the biggest issue facing our global economy, which is not at all what you think it is. Now, there's one thing we can all do together to save the global economy from a total collapse, and that is to collectively together go over and smash that like button. That's right, liking this one YouTube video will save the entire world. It takes just like 2 seconds, and I greatly appreciate it, so thank you. So what's really going on in the global economy? Well, the reality might surprise you, because despite what's going on crypto Twitter and financial Twitter or FinTwit, the real elephant in the room is not the collapse of one bank, and certainly experts believe that the collapse of Credit Suisse would not create a global economic crisis. No, this is not 2008, where a Lehman moment is going to trigger a chain reaction of events. No, it's 2022, and the biggest risk is at the sovereign level. Let's take a second and look at the entire macro picture so you can understand how this is happening. First of all, let's talk currencies. Over the last week, we've seen a dramatic collapse in both the euro and the pound. Currencies this big should not be moving up and down with the volatility of a Shiba Inu clone. That is not good. And why exactly is all of this happening? Well, the answer is pretty simple. The Federal Reserve and the central banks are on a mission to combat inflation. We've been seeing the tough talk out of the Federal Reserve and unprecedented rates of rate hikes over and over ad nauseum, and it really illustrates just how dramatic this particular financial situation is for the world. As central banks look to fight inflation, liquidity is getting sucked out of every major investing market, from equities, tech stocks, and of course, our beloved cryptocurrency. Despite rapidly rising interest rates, we're only just entering the full brunt of quantitative tightening. And as one analyst says, we're only 1 month into this and everything is starting to fall apart. And of course, we're starting to see topics like credit default swaps become very sexy and trending topics, which is not exactly their nature. You see, once all of Twitter is talking about debt and credit default swaps and interest rates, well, you know something's gone very wrong, because this is Sahara Desert level dry stuff. So to make it at all interesting means, say it with me, this is not great. As one analyst points out, Deutsche Bank and Credit Suisse are tanking more right now than the financial crisis of 2009. He goes on to say that there are many indicators that we are heading towards a major financial crisis. Another comments that Credit Suisse's credit default swaps are close to surpassing levels from the great financial crisis. And we have major Twitter accounts circulating hearsay that major investment banks are on the brink of collapse. We all know who they are: Credit Suisse and Deutsche Bank. It certainly doesn't help that as we discuss a Lehman Brothers style moment, the actual chairman of the board at Credit Suisse, his name is Axel P. Lehman. You really can't make this stuff up. I promise. This is not scripted. This is real life, which is always stranger than fiction. So what's the deal? Is Credit Suisse and Deutsche Bank going to crash the economy? Well, the answer is not really. Even if these two banks do go down, they would likely be bailed out. In fact, many macro analysts have said that this fear is overblown. Looking at Darius Dale as well as Wi-Fi Alpha, two sources that we love to cover here on the channel, both of them think that the fear is way overblown here. And furthermore, many analysts believe that the risk of a full-blown collapse of these banks is overblown. As Carlo Cassio explains here, the risk of default is very low on Credit Suisse, not because they're fine, but because their potential capital hole is too small not to be manageable. There's no reasonable default scenario here, but there is lots of uncertainty. As Alex Good explains, am I jumping up and down to fade the CS panic? No. Is it Lehman? No. Lehman was the cause, CS is the casualty. Could the stock go to zero because of the bond market liquidity issues compounding its asset sale plan? Yes, which is probably relevant to quote financial stability narrative. The point is that even though Credit Suisse and other major banks are absolutely in deep trouble, this doesn't spell the same level of systemic financial risk that we had in 2008. Also, this stuff is happening slowly in real time, where there's a lot of time to prepare for it and to react to it. Whereas the 2008 great financial crisis and the Lehman collapse happened extremely fast, and there was very little time to prepare. More importantly, lightning rarely strikes twice in the same place. And when it comes to the actual banking crisis that we had with individual bank failures in 2008, that that is looking far less likely than one much bigger issue, which is sovereign debt. That's right. This video is about the looming sovereign debt crisis, a crisis that is little discussed, but is easily one of the most important issues in 2022. An issue that, if left unchecked, will lead to things truly breaking. And the only solution is one that you must stay tuned to find out about, because it is extremely important for anyone investing or holding risk assets in this entire decade. The thing is that unlike just a single bank failing, the reality is much more dire when it comes to sovereign debt, because this could mean that entire countries go into default and are no longer able to borrow money to kick the can on their financial issues. And this is because since the great financial crisis, interest rates have been darn near zero. This was a very effective way in rebooting the economy, and it allowed for the economy to grow at an unprecedented rate. But it also allowed for historic amounts of new debt to enter the world, debt that was very, very cheap to pay back. But what happens when you're trying to fight inflation and you start raising the cost of that debt, raising the cost of money? Well, that can mean that the interest payments alone that other countries will owe will start to become so dramatically high that they will be unable to pay them. Now, that's totally fine if the debt is being denominated in a currency that that country controls. For example, if the United States has debts that are denominated in US dollars, well, worst case, they can just print more US dollars and pay the debt back. That's why US Treasury bonds are so low risk, because as long as the United States doesn't crumble, at the very worst, they could print some more money and pay you back your treasury bonds. There's almost no risk unless you believe the United States will completely collapse. However, the problems become much more sophisticated once that debt is denominated in another currency. Let's go ahead and take the example of if Japan has borrowed money from the United States. Guess what? If all of a sudden the amount of interest they need to pay on that debt starts to go up, well, they can't just print those United States dollars. They need to get the money from somewhere else. And that's where we start to enter into the world of a sovereign debt crisis. As Dylan Leclerc highlights here, as inflation continues to hit record highs, pushing towards double digits, Europe is headed for a sovereign debt crisis. Now, since this tweet, the situation has grown from desperate to dire, with interest rates absolutely skyrocketing across the Eurozone and home in the United States. And this is, of course, because raising interest rates is the #1 tool used by the government to lower inflation. So by trying to lower inflation, the government is actually creating this sovereign debt issue. The reality is to control inflation, the rates must come up. However, positive real interest rates, meaning when the interest rates are above actual inflation, meaning you're actually making money by lending money instead of actually really losing a few percentage points to inflation, well, countries with over a certain amount of debt to GDP ratio really can't tolerate that at all. And the United States is way over that limit. So what happens when all of this starts to reach a head? Well, they can't stop raising interest rates to fight inflation. They need to keep the cost of money high, at least try to. So what they're probably going to do is exactly what Arthur Hayes predicted, which is something called yield curve control. Yield curve control, or YCC, is effectively when the government starts buying bonds to lower the interest rates of the bonds and stabilize the financial system. By doing that, they can effectively control the cost of sovereign debt. But in order to do that, they need to print money. So by printing money to control the cost of sovereign debt, they're actually making inflation worse, which is counteracting the goal they have with raising interest rates in the first place. In the end, lower interest rates is great for the economy. So higher interest rates should be seen as a temporary measure to slow inflation and to preserve the power of the currency. Nonetheless, we're seeing the Bank of England have to step in and activate yield curve control to effectively stop their pension system from getting margin called in the last 7 days. We even see Italy, Greece, and Spain with higher debt to GDP ratios than they had during the Euro sovereign debt crisis of the 2010s. And as Tyler Reynolds explains, most people don't understand how bad things are right now in a global sovereign debt crisis. There's no one who has a clean enough balance sheet to bail out the world. The debt will be defaulted on either honestly by defaulting on the bonds or dishonestly through high inflation. The point here is that while this ticking time bomb of sovereign debt seems like it's headed to an inevitable conclusion, the fix, which absolutely must be activated to stabilize the world, is something called yield curve control. Yield curve control is the debasement of the dollar. It's the debasement of the currency in which the bonds are being issued. And you know what that means. We're activating the money printer once again, which inevitably will lead to higher valuations in stocks, real estate, and of course, our beloved cryptocurrencies. This is honestly one of the situations that Bitcoin was designed for. And as rises Bitcoin, so too does the rest of the crypto crypto ecosystem, except with jet fuel. However, fair warning, it might be more complex than just yield curve control up only the portfolio. The government might start flipping on yield curve control and then flipping it off if inflation starts to run too hot. There is no clear roadmap for how the government will navigate this process. They're between a rock and a hard place. But remember, the government will always choose to kick the can when it comes to excess pain and suffering. And that means too high of inflation or a sovereign debt crisis. Both are excess pain and suffering that the government does not want to deal with. So they're going to try to avoid each one, but inevitably over time, they're going to end up spending money, printing money, and trying to kick the can to solve their problems, which means, of course, that the price of Bitcoin and the price of cryptocurrencies, as measured against the US dollar, is headed one direction, long term, and that is up. I hope you enjoyed learning about this sovereign debt crisis, and as scary as it is, the reality is that this is going to open up some of the biggest opportunities in investing history. As extreme changes manifest throughout the global markets, there are also extreme opportunities. As we've seen this year with oil and commodities, so too will be the case once debasement resumes and the US dollar starts losing its value against risk assets. My prediction is that the next phase of growth for risk assets will be violent and quick, and I wouldn't be surprised if by the end of the decade, this process of yield curve control leads to something very close or even above the $1 million Bitcoin. I'll be here covering the ebbs and flows each and every step of the way, and if you got some value out of this video, or you believe that all dogs should go to heaven, then you should smash that like button and subscribe with the bell notification on. As always, I'm EllioTrades, and if you want a free $15 of crypto on all trades over $150, go ahead and sign up for FTX with the link below this video. I truly appreciate it, supports the channel, and to be honest, FTX is the best exchange in the business. It's the one I use, I trust it, I love it, and I highly recommend it. Again, they also have a feature that allows you to dollar cost average, so say you want to set it and forget it, buy $100 of Bitcoin each week for the next 2 years, you can go ahead and set that up in FTX and it'll do it automatically for you. That's automatic DCA, and honestly, one of the lowest risk ways to enter any market is dollar cost averaging. I love their feature set. I highly recommend you check it out. As always, I thank you so much for watching, and I'll see you very soon on the next episode.